Welcome to Ariana's book summary series. I'm Ariana. Every day I'll share the key ideas I learned from a book here with you. Subscribe to my channel now if you don't want to miss it. The book for today is Common Stocks and Uncommon Profits by Philip Fisher. Having a solid knowledge base, good self-discipline, a rational head, and limiting your emotional reactions are requirements for investing in the stock market. To master any of these qualities, effort and focus are necessary. Learning the principles and thinking behind the money market is the best place to begin. The fundamental ideas are constant, despite the market is evolving. A company's fundamentals determine its intrinsic value. Investor perception of the company affects the stock price. Due to variables like external events, management changes, market corrections, and other things, the investor perception can vary from day to day. Common Stocks and Uncommon Profits is a fantastic resource for people who want to understand how the stock market operates and want to invest their hard-earned money wisely. You won't learn how to become wealthy quickly or avoid hard work from this book, but it will provide a number of insightful lessons on how to steadily build and protect your wealth for a financially secure life. Here are my top 3 favorite lessons. Lesson 1. Before investing in a stock, conduct a thorough analysis of it. Naturally, you can't just invest in a company without doing extensive research on it first. First, make a list of the companies you want to research. You could also look up potential names in the sectors that you are most familiar with. Then, you'll need to refine it through careful analysis. Analyze their activity profile, industry analysis, top clients, rivals, and financial management. All of these are difficult to study, which is why the scuttlebutt method can be very effective. It implies speaking with their stakeholders directly and gathering data firsthand. You can then form the most accurate impression of the company possible. Doing such in-depth research can be time-consuming. Make sure you choose the appropriate stocks to work with. Be sure to consider the management style they use and whether they make investments in research and development. When it comes to their product line and services, this indicates how future-focused they are. Additionally, look into their reputation for employee and customer satisfaction to determine whether they have a strong or weak organization. Lesson 2. Always buy low and then sell your stock for a higher price. Buying a stock at a low price and selling it later when the price rises is essentially the best way to increase your wealth. It may seem obvious, but you'd be surprised at how your mindset changes when it comes to practice. When there is money at stake, people frequently panic sell when their stocks fall out of fear of incurring further losses. The stock will typically bounce back, and the price will rise sharply. The average investor will therefore want to board this ship and ride the upward trend out of fear of missing out. This process keeps repeating itself. As a result, the market frequently sees overvalued or undervalued stocks. Long-term investing requires constant forward thinking. Recognize that the market is irrational and always reacts to short-term events. For example, a well-established company may see a decline in profits as a result of an R&D expense. Even though the company will later benefit from this, investors do not see it. Your wealth can significantly increase if you time your entry correctly. When the market dips, maintain your position because they are temporary and keep your eye on the prize. One of the greatest investors of all time, Warren Buffett, once said, "Be fearful when others are greedy, and greedy when others are fearful." Lesson 3. Look for mature companies and stable, long-term profits. Many people are torn between trading and investing. Selling when you notice your stock is declining too soon or taking advantage of recent gains may seem appealing. However, the best investors advise you to always hold on to your market position. The market is irrational and short-term focused, so try not to time it. This means that you should keep your money invested in the companies you've carefully researched rather than trying to buy during the dips and sell at all-time highs, which is actually quite an impossible feat of course, if you notice that there is a significant dip without a valid explanation and the market is simply acting irrationally, you can time your entry points and recurring buys. By fundamental reason, I refer to a shift in the company's fundamentals. Invest in established companies that have high profit margins compared to their operational income, high employee satisfaction, high customer retention and recurrence, and, if possible, patent ownership and large distribution networks. These factors are crucial to any analysis because they determine both the enterprise's present value and its future prospects. Let me summarize here. Common stocks and uncommon profits paves the way to success for all investors by explaining how to analyze stocks, comprehend the market, make wise investments and financial decisions, and profit from them by being patient with the stock market and investing your money for the long term. It is a useful book on the stock market and the evaluation of potential investments because it provides both novice and experienced investors with all the knowledge they need to get started. This book is ideal for you if you want to build and maintain wealth over time. All investors should read and use the strategies described in this book because they have stood the test of time. That's it for today. Remember to like, comment, share this video, and subscribe to my channel. Thanks for watching.